Hi, it's Nero here from Investment Rise. And if you're someone who's thinking about buying an investment property, the question that you need to ask right now is, did APRA just do something that could either kill the property boom or potentially extend it? Now, what am I talking about? Well, as of today, the 6th of October, APRA has come out and instructed all banks and lenders to increase their serviceability buffer rate by 0.5%. So what does that mean? Well, up until this point, if you went for a bank loan and let's just say the bank loan was 2.75%, okay? Well then, that's the interest rate. The bank would then add a buffer of 2.5% on top of that, okay? So 2.75 plus 2.5 works out to be, say, 5.25%. And what they would do is then see, well, could you afford the loan if rates rose to 5.25%? Okay, so they were building in a potential interest rate rise of 2.5% at some point in the future. Okay, now remember, the RBA is not increasing their interest rates, right? This is purely from a serviceability and a borrowing capacity perspective. Okay, now as APRA has now come out and said that instead of having a buffer of 2.5%, they want banks to have a buffer of 3%. So that means again that if the bank rate is 2.75, and now they're saying they need to assess you as if interest rates were 5.75%, and could you afford the loan at that particular interest rate? Okay. Now, all of this is really to ensure that the lending market and our property prices are protected from any kind of steep downturn. All right. But for you as an investor, though, what it will mean is that, broadly speaking, your borrowing capacity will be reduced by 5%. So previously, if you had a borrowing capacity of, say, $500,000 from the end of October, or I guess in early November, your borrowing capacity would be 5% less, or $475,000. If your borrowing capacity was $1 million, well, then that would mean that your borrowing capacity would now be, say, $950,000. Okay, so we're talking about a 5% reduction in borrowing capacity across the board. All right, now, so who is that going to impact? Well, it will certainly impact maybe some first home buyers who were really stretching themselves. Maybe they can't afford as much as they could previous to this change, okay? It may also impact certain investors who've got lots of negatively geared properties, all right? Because, you know, if they've got so much negative cash flow coming out, and now that the serviceability rate has increased, that could impact them as well, right? But it's a very small percentage of people. In fact, I've seen some brokers come out and say that they're expecting that less than 2% of people looking to borrow will be affected going forwards. All right. So if that's the impact on only, say, 2% of borrowers, what's the impact on property prices? Okay. Well, first of all, the changes from APRA is not going to affect anyone who's already got a home loan. Okay. Because that means they can afford their loans. So, and with interest rates not rising, it's not as if all of a sudden you're going to see people struggling to pay their mortgages and, you know, properties being sold for less than what they were bought for. That's not going to happen. So you're not going to see property prices fall. Okay. And remember as well, as recently as of a couple of weeks ago, the Reserve Bank of Australia has come out and recommitted to keeping interest rates low till at least 2024, if not further than that. All right. So we know that rates are going to stay low for quite some time. And when we look at the fact that there's some massive supply issues at the moment, put simply, there just aren't enough houses available for people who want to buy them. In fact, according to data from SQM Research, property listings are down a whopping 25.9% compared to this time last year. Now, the biggest supply shortages are in places like Brisbane, Canberra, and Hobart. Okay, so with rates staying low, interest rates staying low, with these massive supply shortages, property prices, I expect, will still continue to increase. However, what APRA has done will certainly start to curb the rate of growth. Okay, so we're not going to see another 20% growth like we have in Sydney for the last 12 months. I do not expect that you're going to see that in the next 12 months. Okay, I do expect that the more expensive markets, so the markets like Sydney, Melbourne, potentially Canberra, even Hobart, those are the markets that will be impacted more by what APRA has done. And when I say what they'll be impacted by, yes, prices will rise, but they're not going to rise anywhere near as much as what you've seen in the previous 12 months. All right. However, markets where they don't have those affordability issues, markets such as your Brisbanes and Perths, I expect those markets to continue to rocket along. I doubt these changes will have almost any impact on those markets. Right. So as an investor, what does it mean for you? It means that don't expect prices to fall, expect prices to rise. However, you are going to have to do your due diligence. You will want to probably look at getting professional help, because I think investors will end up falling into one of three camps going forwards. The first ones, they're going to believe some of what I expect you'll see in the mainstream media going forwards, and the doomsday people saying property prices are going to fall. They're going to stay out of the market, and 12 months time, they're going to wish they hadn't. So that's the first camp. The second camp, investors who are going to buy based on emotion. They're going to buy maybe because their friend bought an area 6 months ago and has done well, and then they're going to jump in, and they're not going to look at data, and they're not going to understand what this change by APRA is going to mean for the market going forwards. And sure, they're going to make a little bit of capital growth. But I think you're going to see a third group of investors. They're the ones who are going to do their due diligence or get professional help, and they're the ones who are going to target markets and find markets that will still grow quite significantly over the next 12 months. All right. And so the question for you is this: as a property investor, which camp are you going to fall into? Are you going to stay out of the market? Are you going to buy on emotion, maybe only make a little bit? Or are you going to do your due diligence and really find those markets where affordability is not an issue, where rents are covering the mortgage, and where you can still get significant capital growth? That choice is up to you. Hi, it's Nero here again, and thanks so much for watching. If you like what you saw and you want to find out more, then I've got something exciting for you. I'm running a brand new live 2-hour broadcast coming up, and you can get a free ticket by clicking the link below in the description. Now, here's a quick snapshot of what we'll be covering. We'll be covering how to predict the future of property prices with uncanny accuracy, so you don't miss out on capital growth. And you can also work out how to avoid the areas that are getting close to their peak. We'll also be covering how to use the equity in your home and invest in property to pay off your personal mortgage in 9 years or less. Plus, how to redirect a good chunk of the money you currently pay in income tax, and how to redirect it towards your personal mortgage or towards building wealth. Plus so much more. But there are only limited seats available, so click the link below and make sure you book a seat, and I look forward to seeing you there. And if you click the link below and then you either don't see a date that's valid, or maybe that there are no more seats available, well, that means that you've missed out. So if you're watching this right now, don't delay, click the link below and register for my upcoming 2-hour live broadcast.